Ahoy there, traders! Thank you for taking a moment out of your schedule. Adrian, Emily, hello, Glenn, Ian, Kevin, two Kevins, three Kevins, hello. Scott, Vito, welcome one, welcome all. I just want to again say thank you for just taking a moment out your day. There's lots of things that we could be doing with our day. It is Friday after all. I typically like to keep my schedule free on a Friday, so I can pretty much have what turns out to be a long weekend. So it's not unnoticed. So thank you for your time and your attention. Hopefully I will serve you as best I can today. We're going to look at the markets, of course. We're going to look at or continue with the This is the May theme. I'm going to milk it. I've got a couple of weeks where I can get a Star Wars theme in every week. But nonetheless, that's what we're going to do. So we're going to look at the markets. We're going to look at retracements and just answer a few questions about the markets and basically how to determine when to panic or when not to panic from a stock market correction or a retracement, or is it a crash? You know, we've seen all of those headlines this week. It's a retracement, it's a crash. Oh my God, panic, blood on the streets. And then quite literally yesterday, it's panic over, you know, nothing to worry about, nothing to see here. So we've seen a full spectrum of movement in the last few days. So should we panic? How do we determine if we should or we shouldn't, what to do about it, and all that good stuff? The usual agenda is the usual agenda. We're going to spend about 20 to 30 minutes talking about that specific thing and link it into the markets. And then we're going to look at see if we can find something to trade. If you are new, I can see one or two new names in the group. My name's Phil Newton. I'm not a Wall Street guru. I'm not worked in the city. I'm just one of those fortunate people to have figured it out and cracked the code. I'm just a regular guy. And I'd just like to say it's all Rob's fault. I dove into my favorite pastime yesterday. He phoned me up to have a little bit of a chat, and he just planted that seed of, are you in a coffee shop eating cake by any chance? I wasn't, but 10 minutes later I was, and I blame him for my slipping off the bandwagon and diving headfirst into some cake. So it's all your fault, Rob. What have I done this morning? I often refer to myself as a lifestyle trader. You know, what that means to me is I get to do whatever I want to do whenever I want to do it. I like doing these sessions. I like interacting with traders. I like generally being able to do whatever I want to do whenever I want to do it with whoever I want to do it. I'm not the type of person that likes to sit on a beach. That's not my idea of a lifestyle. But if it's yours, that's great. That's your lifestyle trade. So what my morning consisted of, I actually went on, I'm quite enjoying this at the moment. Most days, 4 or 5 times a week, I go on an urban ramble. And this is just some of the shots of my kind of local Liverpool city centre. You might recognize this one on the left, and I pointed out because we have had the new Batman movie. We have a lot of filming done in Liverpool, and you might recognize this building in the upcoming movie, along with one or two others which I didn't get round to today. But Batman was on the top of this building at one point, which was a sight to see. But nonetheless, we've got 2 cathedrals in Liverpool. We've got the Anglican and the Christian cathedral, or the Catholic cathedral rather. But we've got lovely views. So this is, again, the Catholic cathedral. I rocketed myself up these stairs. They don't look that big on the one on the left, but this one, you know, the view is quite spectacular, and we can see this cathedral at the other end of the street. So I basically did a little bit of an urban ramble. And the reason why I mention it is, you know, it's because of this process that I keep explaining to you every week, this production line process that I keep talking about. It allows me to find opportunities. It allows me to profit from them. And then it allows me to go and do something else with the rest of my day. So this is what I've done with my morning. Now, bear in mind, I'm in the UK, so I'm 5 hours ahead of the US, and I appreciate there's lots of people here that are in the US as well. But all I'm trying to illustrate is, you know, when you've got a clear definition on what you're doing, we should never be spending hours looking through charts. We should never be wondering what to trade or where the trade is. We're not playing that where's Wally game. We want to be able to zero in and go, there's the trade right there. There is the trade. And as such, put the trade on. And that's what I'm looking to do. And that's what I'm trying to teach, all my students. And that's in part what we do every week. So it allows me to go and do. So all I pose the question is if you're spending hours flicking through chart after charts, I would say that you're doing it wrong. So give some thought to what you're looking for, what's your desired outcome, and then maybe you can go and do something better with the rest of your day, whether it's spend time with the family, go and spend time with the kids, go and find a little bit of an adventure around your local area. What's your idea of a good lifestyle? I've got my idea. I like a nice relaxing pace of life. And this is what I want to do with my time. So that's what I want to pose you. That's the whole purpose of doing this. It's to live around trading and not to trade around living. So it's just to pose a little bit of a thought there for you. Anyway, before I get too much off the beaten track and go all Zen-like and start hugging trees, this is the May. A couple of questions from lots of different people this week. They all revolve around this theme. Do we have a crash? Is the market correcting? And how do we tell if it's a retracement or if the market's selling off longer, faster, deeper? Should we wait? Should we cash out? Should we take profits? All those related questions, because on Monday, Tuesday, we saw a very sharp movement, and it was to the downside. And we've been very fortunate in the last 12 months that the stock market only seems to want to go up. And when we see these red days, down days, it kind of catches everyone on the wrong foot. And it does make you pause for thought. What should we do about it? Is it just a one-day correction, which seems to be very common at the moment? We're seeing plenty of 1, maybe 2-day corrections. And how do we deal with it? Is it a crash? Is it correction? Is it retracement? Should we buy the dip? All those questions, all those related themes start getting asked. And then we fast forward to where we are today. And it's like Monday, Tuesday never happened. The market's back where it was. It's rallying again hard and fast. And the crash has been cancelled. So all those panicky questions that I've received, and maybe you've been thinking on Monday and Tuesday, oh my God, blood on the streets, and all those crazy news media headlines of it's crashing, the stock market's crashed, X%, and there's blood on the streets. Oh my God, Chicken Little, doom and gloom. With just a few days worth of hindsight, it was nothing to worry about. Nothing to worry about. So how do we tell? How do we stay sane the next time it happens? So we need to think about the market correction. There's basically an accumulation, which is a fancy way of saying consolidation. We've got advancing, which is a fancy way of saying going up. We've got distribution, which is another way of saying consolidation. And we only know it's distribution because afterwards the market declines. So we can only look at it's either going sideways, it's going up, or it's going down, up, down, or side. There's only 3 things. But depending on where those 3 things happen, we could call it accumulation, advancing, declining, or distribution. And that really is the market. Another way of thinking about this is I like the Elliott wave way of describing this. Sometimes Elliott wave uses a tidal metaphor. It's like a tide going in, it's like a tide going out, in, out, in, out. Sometimes there's a storm at sea, sometimes the waters are really calm. So I kind of like that type of metaphor. So the stock market's the same. It's always expanding, it's always contracting, it's always trending, it's always moving. The tide is always going in, it's always going out, it's always in motion is the point. And what we're trying to do as traders or stock market traders is to try and figure out, okay, well, what's price doing? What's price doing? And is there anything for me to trade, secondly, or is there anything for me to panic about? Or should I be on the sidelines waiting? These are all the questions. Do I need to take action or be patient and wait for the appropriate time to place a trade? So these are all kind of questions that we're asking, just reinforced by the situation that we've seen this week. We've seen all of these things happen this week. We've seen the market pause. We've seen it advance. We've seen it decline quite sharply. all of these things happen this week at a very fast, extreme example of a correction or a retracement. But it can be mistaken for that crash. Everyone thinks, Chicken Little. So let's go and take a look at it. How do we stay sane is the question. When the markets are moving and they're doing something a little bit faster than normal, how do we tell if we should panic? So we're looking at the S&P, futures, and we've got 3 lines on the chart. So we've got the 200 period moving average, we've got the 50 period moving average, and we've got the dotted line just here. We've got the 20 period moving average. I think what I'll do actually, I'll just change that to a solid line so that you guys and girls can see it a little bit more easily. Just bear with me a second. Just going to change the style. We got the right one? There we go. That's what we want. There we go. Okay, so that should be a little easier to see now. So we've got the 50, the 200, the 50, and the 20. So the fact that we're using these moving averages is not really that important. If I was doing this exercise 3 years ago, I would have been talking about it in the context of Bollinger Bands, because at the time, 3 years ago, that was my preferred tool. I'm not saying indicator, I'm not saying signal generator, it's just a line in the sand, a reference point. Another tool that I like is Williams percentage R. Again, I can talk about the same thing in context to Williams percentage R. All I'm trying to highlight is that the tool doesn't matter. That's the same tool, just an overlay on price. So what I'm trying to get to is choose a tool that makes sense to you. If you like using Elliott wave, down theory, GAN theory, if you like using Fibonacci, if you like using moving averages, which is what we're going to cover today, it doesn't matter a great deal about the tool that you use. The same principles that we're looking at or we're going to be talking about to help us determine, should we panic? Is it a correction? Is it retracements? We can put that same context into any tool that you prefer to use. And I'm emphasizing the word tool, and I'm emphasizing this point intentionally because it doesn't matter the tool that we use. There's no magic formula. There's no magic indicator. There is a methodology to using the tool that you want to use. Now, what I like to use at the moment is moving averages. We've got 3 of them on here. And if we were doing this just 12 months ago, we would have been using 2 moving averages. It doesn't matter is the point. What is more important is how does price interact? And when I say price, the red and the green bars, the candles, how does price interact with the tool that you're using? In this case, moving averages. So what I've done is I've created and devised a system that allows us to interpret the chart without you having to learn Dow theory, GAN theory, Elliott wave theory. It's a really simple process. And we go through it at most weeks or some version of it to try and find trading opportunities. But we can also use it to help us give a structure to interpreting the chart and learn what phase of movements are we accumulating? Are we trending up? Are we trending down? Are we in a distribution phase? One of those phases of the market movements, because it's either going up, down, or sideways. So how do we determine if the market is trending or retracing? So one of the things that we can do is say, okay, over here on the left, that's where the 50 period went above the 200 period moving average. So the short-term average is now above the longer-term average. And price in itself is also above that 200 period moving average. So as long as those 3 things happen, we can have a bullish bias on the markets. So I don't need to worry about selling shorts and thinking about crashing and selling rallies. I only want to be buying dips when the average of the average, the 50 is above the 200 and price is above both of them. I only need to worry about buying dips, and I can start saying we're in a trending phase. It's in that rally higher mode that we looked at earlier. So when I know that, I can start to say things like, well, any downward movements is either one, noise, or two, a retracement in an uptrend. So it's either going to be one, noise, or two, a BTFD opportunity, by the insert expletive dip opportunity. So what we can start doing is we can start looking at, okay, well, where is price in relation to the 50, the 20, the 200, the 50, and the 20? We've got the average prices going up, so I've got a general bullish bias. And I'm going to say that noise is when price is above all three averages. It's doing what we want it to do, in that it's going up, and presumably we would have a trade on. If we're following my process and my trading rules, you would have a trade on, and I can ignore the red and the green bars, because any up day or down day, red or green for that matter, is just noise in the context of the trend. It's doing what we want it to do. It's going up. So I can not worry about, is today an up day, is today a down day? I just need to know that it's moving in the right direction. So does that make sense? So that's noise. The average prices are all crossed up, prices above the average prices. Everything's doing what we want it to do. There's no need to panic. Does everyone get that kind of first step, that first point? Noise, nothing to do. It's doing what we expected. Great. That's exactly what we wanted. Nothing to see here. Carry on. Let the trade do what it's going to do. Wait for the profit target. Wait for price to carry on going up. That's all we need to do. Noise. Forget about it. So that brings us on to the, well, when is a dip a dip? When is a retracement a buyable retracement? That's what we want to, that's kind of important. What if we're not in a trade yet? What if we're waiting for an opportunity? So we can start looking at the times where price goes from above the, there we go, we've got the 20, the 50, the 200. I think we all know what these are now. But we're all, when price is above, that's our trade opportunity. So what I can say is when price is below the 20 or below the 50, then that is my BTFD. That's my buy the dip opportunity. So it happens there, and we want to profit as it moves away from the moving averages. As it comes back into the average prices below the 20, below the 50, then that's my BTFD opportunity, buy the dip opportunity. So price here comes below the 20. It comes down, in this case, to the 50 period moving out. I sent an email out on Wednesday to everyone that's on my email list saying this is nothing to panic about. This is a buying opportunity. This is still in dip or retracement mode. But if it goes below the 50, that's going to be my line in the sand. As long as it stays above the 50, then I've got a buying opportunity. This is what buy the dip. So this is these red bars as price goes below the 20 and towards the 50. This is my opportunity to buy the dip. Does that make sense? Let me just pause there. So this is just looking at the moving averages very simply as an over under. Just pop a little yes in the chat box. We get you, Phil. We're all on the same page. If you've got any questions, now's the time to type them out and I'll address them. But this just gives us a line in the sand to say, yeah, I'm going to be bullish above, bearish below, or I'm going to be in waiting mode, no action to take. So if we're below the 50 and above the 200, this is my no action zone, noise, weights. If it's above the 20, above the 50, again, I've got that no action zone. I should be in a trade. Wait for the movement to carry on going the right way. If it's below the 50, no trade, waits. But when it's kind of moving away from or back in line with the direction, the overall trend, then I can start saying, okay, looking for my entry opportunity to buy the dip, buy the dip. Question from Loy. Do I put a spread on options or is it a vertical spread? They're both the same thing. You could, how could you trade this? You could you could sell a put spread. You could buy a debit spread, a call debit spread. You could buy a single call, would be one way. You could buy stock. In this case, because we're looking at futures, you could buy futures. They're all ways to express a bullish viewpoint. You can do all of those things, Lon. Which one is right for you might be dependent on your account size. So if you've got a small account, I tend to urge people towards a debit spread if you want to trade it directionally. If you prefer a more income styled strategy, you can use the same philosophy, but sell a put credit spread and collect an income. And then you don't necessarily need the directional move. As long as it doesn't go down, you'll get paid. So there's a lot of different ways of using this information to express the trade. And which one, again, it just depends on personal preference. I like to trade directionally. So I'm usually going to trade calls on the ETFs or the stocks, which we'll look at in a moment. That's typically what I like to do. Adrian, good question. When do you get out of a trade? Similar question. We had this question last week. We're looking at S&P futures. Let me just zoom in. What does this, just looking at the last 6 to 8 months, what's a typical move? What's a typical move? You don't need to overcomplicate this. Just look back over, say, 6 months. What on average does this move? Well, it went from 3,700 there. It went to 3,900. Okay, so there's 200 S&P points right there. Did the same thing there. There's 200 S&P points there. It went from 39 up to 42. So we've got 300 S&P points there. So it's looking like somewhere between 200 and 300 S&P points. That seems to be what it's doing. Now let's look at the time. It looks like it's doing that in, about one month periods. Does that make sense? So when to get out, just look at what's happened previously. Don't overthink this. Look at an average movement over the last 6 months, 8 months, 12 months. If you're not sure about that, you can change it to my typical time in trades a month. Pop a monthly chart on and just add an indicator. Do I have it on the chart? Average true range. Average true range. Well, look at that. Look at that. Average true range on a monthly chart is about 310 points. We've just worked that out manually. Somewhere between 200 and 300 is a typical month. And if you look back over the last, again, probably can ignore the crash there. We go back to, all the way back here, typical month, the same answer in 2013, you're looking at about 100 S&P points. So the volatility is a little bit more at the moment. And it's not because of the crash. If you put it into context, there's 20, where the crosshairs are. This is the monthly chart. So there's only 2 months where the COVID crash struck, and we were already seeing an increase in volatility, an increase in the monthly range of movements. So you don't have to overcomplicate this, Adrian. Like, what's a typical move look like? So if I was to say in the next month, S&P is going to move 500, 600 points higher, that's my trade idea in the next month. That's an unrealistic expectation. Does that make sense? If I said this is going up 600 points in insert time in the next month, that's twice as much as what it's currently doing. It's an unrealistic target. Now, 300 is at the upper edge of, well, that's what it's doing right now. That's at the upper edge of what it's doing right now. So maybe half of that, somewhere between 150 and 300, is a good sweet spot to be thinking, okay, it's done what we expect it to do. And you can apply the same logic, whether you're looking at futures, whether you're looking at stocks, ETFs, you can look at crypto, gagging on the phrase, you can look at oil. The same principles hold true. So just very simply look at an average typical movement. Where was I? Oh yeah. So thinking about retracements, prices retrace back to the 50. So let's add your question. Where could this get to? If this is going to be a trending move to a new high, We're looking for between 400 from 4,000 approximately is the low. And we know that in the next month, it could go 200 to 300 points higher. Well, 200 takes us back up to the high. So it could go to 4,300 by the middle of next month, middle of June. What do you reckon? Does that seem like a realistic expectation? Well, let's just open the question. Let's open that up. Does that seem like a realistic expectation for this trade? Yeah, so that's the thing. What we've got now is we've got structure. We've started off with saying, okay, well, we should be buying the dip, BTFD, or selling the rallies. We've now got a structure using moving averages to say, you know what, when it's back to the 50-period moving average, I'm going to be really interested in saying that that's now retraced enough, and I'm going to buy that dip. Now, again, thanks to Adrian's question, we've got, well, where could it go? And we know all of this in 60 seconds. It took me longer to explain it than to do it. Just very simply look back and look at an average movement. So now this is obviously idealized. Let's look at the NASDAQ, because the NASDAQ's doing something a little bit different. So how do we tell whether is it a dip that we can buy, or should we wait? Well, there's the 50-period moving average, there's the 20, and there's the 200. So what we can start to say now is, well, price for the moment, it's below the 50. It's above the 20. So again, the average prices are going up. So I do have a bullish bias, but this is not yet. It is retracing. It is moving down, but it's still below the 50. Again, remember, we're just going to use the 50-period moving averages and over under. Right now, it's below the 50. It could still move lower. It could still move lower. So rather than worry about, let's buy the dip, let's, see if there's an opportunity to buy. Well, let's worry about it when it goes back above that 50-period moving average. I don't need to worry about it today. Don't need to worry about it today. So let's say if it's above the 50, I'm going to be bullish. If it's below the 50, I'm going to be not necessarily be bearish, but I'm going to be in wait mode, because it could continue to move low. It could continue to kind of just do what it did over here and just meander sideways for, many days, many weeks. So just applying that over under on the 50-period moving average, you avoid all of that bullshit right there. And that could happen again here. We don't know if it will or it won't. So we can use that moving average to say, you know what, if it's above it, I'll resume looking for an entry to go long and get involved in the dip buying process. But I think out of the two charts that we've looked at so far, the S&P looks far better. Visually, we can see that it's trending. These retracements back to the 50-period moving average look a lot easier to identify. Same with the Dow. We look at the Dow, it's a lot easier to identify that, oh yeah, this is a dip in an uptrend. And yet when we get to the NASDAQ, it's a little bit sloppy, a little bit messy. Let's not worry about trading the NASDAQ right now. Let's not worry about trading the NASDAQ right now. I don't have to trade it. Let's make it easy for ourselves. Let's do the same with the Russell. Now we're looking at the Russell. What's going on? It's tried going above the 50 once, twice. So maybe a couple of false starts. Right now, it's below the 50. Let's not worry about trying to get in on the Russell futures. Let's just identify that, yeah, it's in a bullish uptrend, but in the short term, we can see that price, now we're looking at it visually, it's going sideways. Let's not worry about it. Let's wait for it to prove that it's resuming its upward movement. Does that make sense? I just want to pause here. This is what I mentioned earlier when I said, if we imagine that game, Where's Wally, Where's Waldo, wherever you're on the world, it's a slightly different name. But I don't want to play Where's Wally. I don't want to go, where's the trade on Russell? I don't know. Where's the trade on the NASDAQ? I don't know. Where's the trade on the S&P? Oh, there it is right there. There it is. It's now a statement instead of a question. So what I'm trying to get around to is make it easy for yourself. Use an indicator that makes sense to you. I use the 50, the 200, and the 20 period moving average to help give me a structure, a framework. And whether it's above the 50 or below the 50, or above the 20 or the 200 or below either of those, I've got this way to measure, like, where is price in relation to the tool that I'm using? And that means that I can take that logic, that philosophy, that production line to a different chart, a different indicator, a different market. I can take it to a different time frame, any time frame that I want, and apply that same logic, because that's what having a production line trading process allows me to do. And it means that I can do sessions like this. It means that I can go for, walks for hours at a day and go urban rambling, which is what I'm really enjoying doing at the moment. And just go and do whatever I want to do, because I can look at a chart now and say, yeah, it's buy the dip on the S&P. On the Dow futures, it's buy the dip. On the NASDAQ, let's not worry about it. On the Russell, let's not worry about it. And just find the best opportunities that make sense relative to a trend trading methodology, which is what we go through all the time. We typically use Twitter as our perfect example. We've been through the rules that we use multiple times on multiple occasions to explain this trend trading process. We find plenty of charts, plenty of trading opportunity. This is Hess. Again, we've been following this one in real time. We found this all the way back in January, February as our first early stage trend. It's now moving from $60 up to $85. So we've got the same process, the same principle is what you've been seeing. And now we can start to say, well, all of those red days. So now the red days that we saw on this trade that we've been following in real time for the last few months, those red days, we can now say that's noise. It's a red day in the context of a rally. It's in rally mode. It's above the 200, above the 50, above the 20. We've got trades on. It's in rally mode. That red day is noise. Ignore it. It's not a panic situation. Does that make sense? So when we've got structure, we can start to apply it to trade. Should I worry? Should I panic? Should I do something with this trade or not? Or, should I wait for a new opportunity or not, as the case may be? So now we've got, again, just looking at some of the trades that we've been following. We looked at lots of these last week. So here's Hess again, HES. We looked at Twitter. Again, last week we looked at PSX, again, an early stage trend. So that the red days that we saw earlier this week, it's just noise in the context of the trend. It's starting to go into rally mode. Again, 10, this is in rally mode. WDC, so we're back into waiting mode on Western Digital. So if you're not in a trade, now's not the time to be worried about it. If you are in a trade, maybe you're thinking about managing it. We've got a little bit of a false start. Again, looking at X, the red days, they're just noise. It's a retracement in the context of an uptrend. It's not managed the trade yet, but it's certainly, maybe it's going to carry on retracing. Going back to BYD, again, we've got price retracing back below the 50 here. So we've got a structure to say, you know what, it's below the 50 period moving average. It's putting in a deeper retracements. We've been monitoring this all this year and a lot of last year. It's now below the 50 period moving average. Well, it's not done that in the last 12 months. So maybe now that we've got structure, we've got context, maybe this retracement here, we can say that it's doing something new. It's doing something different compared to the last 8 to 12 months. So maybe I don't worry about looking for an entry until it's proven to start moving back above not just the 20, but also maybe the 50, but also the 20 period moving average. Wait for it to prove itself, to prove that it's resuming its upward movements. I don't have to worry about it right now because I've got structure, I've got a framework, very simply that are using moving average. I don't have to interpret it. It's either above or below the 50 period moving average. Does that make sense? Everyone happy with that logic of where is price in relation to the trend? And if we're in a trade, we can start applying the same logic. It's just noise or it's retracement. Maybe I should manage the trade. Maybe I should close it out and not wait for it to hit stop loss. If we're above the moving averages, it's a case of, okay, it's doing what we wanted it to do. That's great. All of these things allow us to evaluate the trading opportunity, the trade in front of us. Some trades that we're looking at, same logic, same philosophy. So these are some contenders that I'm watching. SLCA, can we all see that this is a retracement in the context of an uptrend? It's currently below the 50-period moving average, so I don't need to worry about a trade entry just yet. But as it goes above somewhere around $12, I can start thinking about, well, maybe that's the resumption of the upward movement. Easy peasy. Let's think about IGT. Now, IGT, same thing. I mentioned this on the podcast earlier in the week, but we've got our average prices going up. Average prices going up. We're above the 50-period moving average right there. Visually, we can see a consolidation. So if we weren't in as it moved above the 50-period moving average, we can certainly consider it on what we usually call a breakout. Nice and simple to identify. LB. We've got a couple of red days, teeny tiny consolidation. This hasn't really come back to the 50 in the last in the last 12 months. So a move below the 20-period moving average, or back to the 20, which is where we're at right now. Tiny consolidation. I'd be looking at an entry above $70. Small breakouts to a new high in the context of an uptrend. If it goes back below the 50, I can start evaluating and saying, you know what, maybe something new is developing. It's out of context with the last 12 months. So if price was to go below the 50, like with one of the other charts we just looked at, we can start, where is price in relation? And then comparing it to what it's done previously. Oh, it's doing something new. Maybe I just wait a little bit. I don't need to worry about it just yet. I can evaluate and see that the theme, the ebbing and flowing of price is doing something a little bit differently. Let's see if we can find another example of that. So again, MO. Average prices are crossed up. We've got our usual in trend for 40 days. It's going up. We can see that visually. The retracement that we've seen back below the 50, it's just going back above the 50 here. So we can start thinking about an entry around this point and looking for a move higher. Coming back to Adrian's question earlier, where could it get to? Assuming that you like this one and it's looking good, where could it get to? Well, all you need to do is look at the segments of the chart. You know, you can break it up and look at how much price has moved previously. And you can, even in the consolidations, even in the messy parts of the chart, you can kind of get a feel for, okay, well, in a 1 to 2 month period, this looks like it moves, you know, $3 to $4 when it's consolidating, and when it's trending, it looks like what have we got? Potentially up to $5. Oops, $5. So anywhere from $3 to $4 at the low end, and potentially up to $5 in a 1 month period. We can start to sensibly identify targets relative to what price has done previously in a time horizon that makes sense. My trades, again, I just want to reinforce, my trades typically last about 30 days with this process. So I'm just looking at there's a grid in the background. If I just highlight it, you can see it there. All of that, all the grids last for about a month. So I can easily identify in about a 1 month period, it normally does $3 to $4. Great. So I've now got a sensible target from 50 to 54. Seems like a fairly reasonable target in the next 30 days. Great. So if it's not doing a $3 move in the next 20 to 30 days, then I'm either behind schedule or ahead of schedule. If it smashes through it, great. It's done what I wanted to do. Take profits, go home, look for another opportunity. Just seeing your question, Lloyd. So when you trade with an option, with an ATR, so trading options, they have an expiration date. Expiration, I would always have more time. Although I only plan for 30 days, I usually buy 90 or 100 days or more. I always buy more time than I actually need. Better to have it and not need it than to need it and not have it. The worst thing you can do is think, okay, my average time in trade is 30 days. So you buy a 30-day option. You know, you're just hobbling yourself. You really are going to hobble yourself if you do that. So always buy more time than you actually need. Again, a general rule of thumb is to buy twice as much time as you think you need. Again, I usually go for 3 or 4 times. Again, it's just bet. It just gives you choices to manage the trade more effectively. Cool, cool, cool. So structure and logic. We've got a very simple methodology to look at how to interpret the ebb and flow of the chart. Again, with any chart that we're looking at, whether it's Apple, whether it's futures, whether it's stock. So again, we're looking at Apple right now. Now we've got our philosophy. We can see that the average prices, they're all really close together. So that's just telling us what we can see visually. Visually, price is kind of going sideways. And as we're looking at it right now, that's what it's doing. The average price is really close. It looks like they're flipping and flopping back and forth. So we've got a trending tool that's helping us find a consolidation. Great. Well, now I know what phase the market's in. The average prices are really close together. It's below the 50, really close to the 200. Let's tidy up. It's below the 50, really close to the 200, really close to the 50. They're super close together. Again, visually, a little bit of common sense. A little bit of common sense. Look at the whole chart. It's been going sideways since last August. So maybe I don't worry about the moving averages on this occasion because I can override my over under the $50 level with a little bit of common sense. And so, you know what, it's in a consolidation until something new happens, something new being a breakout, up or down would be a breakout. One of the 6 trends that we like to trade. Until it does something new, I'm probably not that interested in Apple. Probably not that interested in Apple. Visual confirmation. Let's look at Amazon. What do you think? Now we've got this over under. It's below the 50, below the 200, the 20 period's right there. So price is right next to all of those averages. Now we're looking at the chart. Visually, we can see that it's kind of meandering sideways. So let's throw the question open. Would you trade this stock or would you leave it alone and go and find something else? Would you trade this stock or leave it alone? Yeah, it's not a trick question. Absolutely. Everyone's saying leave it alone, leave it alone. Yeah, I mean, there's ways you could trade the range, but you know what? Why make it difficult for ourselves? Why make it difficult? I'm a trend trader. I want to buy dips. I want to sell rallies. Is this stock trending right now? No, it's not. It's in a consolidation. So we can use the where's price in relation to the averages. And we can also add in, well, where are the averages in relation to each other? They're all really close together. So it's probably a consolidation. Oh, and when we kind of zoom out and we look visually at the charts, it's easy to see that price is in a range. So again, rather than think about how do we trade this chart, the trap that a lot of novice traders fall into is how do I trade this chart? How do I trade it? Now that I'm looking in this chart, we don't want to fall into the trap of like trying to force a trade. Now I'm looking at Amazon. How do I place a trade? Where do I place a trade? How do I get in? And then you spend 2 hours drawing trend lines and Dow theory and Gann theory and Fibonacci and all the other bullshits. And the reality is you just want to be able to go, you know what, there's no trade there. Let's go and look at something else. Again, we've got a very simple way to use the watch list over here on the left. Now that we've got, again, just a different perspective on the moving averages, we can see that these watch list tools over here on the left that I'm highlighting, they're helping us find you know, the trend phases. We've been through this many times. You know, we're looking for the days in trend. We've got the which way is the trend. We can see if it's going actually up or down in the last 60 days here. So we can do all of the heavy lifting in the watch list without ever looking at or without really needing to look at the charts. So we have a very easy way to say, you know what, this is either trending or not trending. So I can look down at all of these tools, and a lot of these are just built in. I've had them customized to display a little bit differently, but it just allows me to make the same evaluation without looking at the chart. This is my top 50 list, but if I wanted to look at every chart every day, if I wanted to look at just the top 50, again, this is what you can see there in view is the top 50. It should be very easy to now, you've like buy the dip. It's not today. Buy the dip. Oh, could be something interesting on this one. DD, again, it's between the moving averages. Let's leave it alone. It's above the moving average. It's in rally mode. Again, I've already got a trade on this one. What have we got to trade on this one? So you can see that we've got the rally to a new high, a little bit of a pullback. We've got, you know, price retracing. It's noise. If, you know, I can leave it alone and not worry about the trade. We've got a very easy way to make evaluation. So if you did want to look at some individual stocks, we've got a very simple way, and this is quite literally as fast as I do it. A way to say, yeah, it's either yes or no. It's either trending or not trending. It's either in a retracement mode or it's in a rally mode or a sell-off mode if it's in a downtrend. We've got a very simple way. I actually like MO. MO is probably something that I'm going to do today. It was on my shortlist. We've got our average prices crossed over. It's been 40 days in trend. We've been going up. Now that we're looking at this chart visually, we can see it. It's retraced below the 50. It's gone back above the 50 a few days ago. We've got a little bit of a pullback here. So we've got a little bit of a price entry right there. And again, I'm not already in a trade, but I'm looking at a trade entry. We've already established that this could go about $4 or $5, which is 10% on a $50 stock. So that's fairly reasonable in the next 30 days. So I've got a trade right now. It's very easy to find those opportunities when you've got a structure, when you've got a framework, and you're looking at the best possible stocks that you could trade. So KMX, well, let's take a look at KMX. So one of the things that I, as you know, I do, I'm going to load up 20 years of data. I've got this codified, as you know. I've got this codified, meaning that I'm just getting my little strategy report up. There we go. So meaning that the strategy that I'm using should be able to provide trading opportunities. It should provide a good equity curve. So that's what I'm looking at. So this is one of the trending algorithms that I use. So I'm looking for, like, does it have a consistently profitable trade? Because I know I'm going to trade a trend. I've got it automated and systematized to the point where if I wanted to let the computer trade, it could. So I want to know that, is the stock the best stock to potentially trade this trending strategy over a 20-year period? So let's go and take a look at KMX. So someone suggesting KMX looks interesting. Well, it might have the setup. It is retracing in the context of an uptrend. So it is retracing in the context of an uptrend. It does have the average prices pointed over. It is visually going up. It is retracing below the 50-period moving average, but it's not in my universe of stocks because it's a shitty stock. It doesn't trend on a regular daily, weekly, monthly, yearly, 20-yearly basis for me to ever consider trading KMX. Does that make sense? So someone's just suggesting KMX. I don't mean to, the setup's there. It looks great. We can take the page out the textbook that says this is what a buy the dip trade looks like. We've just been through an example. But I want to trade it also on the best stocks. And I want to take the best stocks, the data that is telling me, the strategy is telling me that this not only is a good setup, it's a good setup on a great stock, or in this case, it's the setup that we want on a shitty stock. I'm not going to trade KMX. So yeah, it looks interesting. And in fairness, it may provide a great trade. It may provide a profitable trade. But I think I would rather trade a stock that has the same setups, Oops, just waiting for the data to load. I think I would rather have a trade setup. Oh, my trade station just seems to have decided to throw a hissy fit. Let's try again. There we go. So this is Boyd. So I think I would rather trade the same buy the dip opportunity on a stock that's been proven to provide great profitable trading opportunities over, in this case, a 20-year period. I'm not going to second guess if I should be in this trade. Does that make sense? So it's not, as I keep trying to suggest, it's not just a case of there's the setup. Like I've curated a stock list that many of you have. Some of you do, some of you don't. It depends on whether you're in my community or not. But I want to trade the best setups on the best stocks, and I don't want to second guess, is this going to work? Because let's face it, that we're all in it to make money. We're all doing this to make money. But it's more than just making money. There's more than just, oh, there's the setup that we want. Is it on a stock that is historically proven to work over not just once or twice? This is all about how do we profit from these types of strategies, these types of setups, not just today and tomorrow, but next week, next month, next year, for the next 20 years. Is this a good stock for me to trade? So I can have the confidence to not only buy the dip, but buy the dip on the right stock at the right time with a high expectation that, you know what, on this stock, well, let's go and look at it. On this stock, I'm not looking at the dollars. On this stock, there's 43% of the time the bullish trades work out. That's better than the 33% probability of just picking the right direction. That's pretty good. I like that. I like those odds. So I'm only going to go long on this one. It produces a nice, steady equity curve. Looks good. Let's check out, again, let's just pick one at random, SLG. SLG, we've got 10, we've got nice positive equity curve. Again, this is another stock. Oh, why is this one? Oh, that's why. I've got the wrong, this is with a different strategy, that's one. Let's look at the trend trader stocks. So again, different strategy, different stocks. So that was for, though that stock list was for a different strategy. So this is Apple, this is the trend trader, you can just see it there. And this is the trend trader strategy. So again, we're just looking for stocks that historically provide great trading opportunities. Again, Apple's a little bit sloppy, a little bit messy at the moment, but long-term, it's providing a great equity curve. I want to know that this is the right stock for the right strategy. And as you just saw me do that, I was just looking at the wrong stocks with the different strategy. So, make sure that we've got the right stocks. They're historically proven to provide great opportunities. And this is one of the three strategies that I tend to teach people. Anyway, trading the trend. How do we know if the dip is a dip? Is it retracing? Is it, where's my little slide deck? Is it retracing? Are we in crash mode? Are we in correction mode? Are we in retracement mode? So we looked at, the red days, just because we see a red day, a down movement, does it mean that we're seeing the market crash? We've seen great examples of this week, Monday, Tuesday, red, upper edge of average range of movement to the downside. Should we be worried? Should we be thinking about a crash? Well, we just looked. Price in the majority of cases was either at, near, or just on the 50-period moving average. So we can probably say it's just a correction. Another way of saying that is a retracement. So this is telling us to, it's wait. It's nothing to worry. It's either noise or we're in wait mode. So that's what we've seen this week. And then yesterday, as we saw price come down to the 50-period moving average, that's the timing. And we saw that on the S&P. Let's just go back to the S&P. We saw that on the S&P with price retracing in the context of an uptrend. And yet the NASDAQ, it's moving in the same way, but it's in context or in relation to the 50-period moving average. It's probably a wait situation. I don't need to worry about this right now. So the S&P, the Dow, they're the better opportunities compared to the NASDAQ and the Russell. Again, they may still provide great charts, great opportunities, but I don't want to second guess. Listen to the way they may provide. They could still provide a great trade. Now, I want to know, if I go back to the S&P, I want to know with absolute certainty that, you know what, this is in the right mode. It's in the right phase of movement. That gives me confidence to place the trade and not second guess myself. If it's a choice between the S&P and the NASDAQ, it's going to be the S&P. If it's a choice between the Dow and the NASDAQ, it's going to be the Dow. If it's a choice between NASDAQ and Russell, you know what? I'm not sure. I'm going to leave it. I'm going to wait for the trades, the charts to prove themselves that they are moving in the right direction. Again, very simply, over under. Is it over or under the 50-period moving average? It just gives you a nice benchmark, a nice framework to help you determine, you know what, should I worry about this today or should I come back tomorrow because it's noise, it's still in retracement mode, it's still in wait mode. Crash mode would be in, we go way below the 200-period moving average from where we are. We've got a nice wide separation here. So if we were suddenly below the 200-period moving average, I think it'd be fair to say everyone would be in agreement that we're in crash mode. And in fairness, let's just go back to let's just go back to the crash last year. So if you don't believe me, you can, well, there's the 200-period moving average. So I've not got enough data loaded, but we were above the average prices. And as price went below the 200, that was when officially it's like, okay, we're in crash mode. And that's what happened in February, March last year. So again, we all know what happened. So we can use that 200-period moving average to say, you know what, we're in bullish mode or in bearish mode. And if we have a sudden move that goes from well above the average prices to well below the average prices, then it's probably a crash. Crashes don't just happen just to belay your fears. They happen once every 10 years. Looking at my research, my studies, crash will call 30%, 20, 30%. They happen about once every 10 years. We've just had one. Chance of happening another one, while not impossible, are slim. Retracements from anywhere from greater than 10%, so we'll call it a healthy correction in the markets. So something like that there. Healthy correction in the market in excess of 10%. And 10% in 10 days is for any of my long-term listeners will know that's kind of like a nice benchmark to use. A fast correction that's in excess of 10% in 10 days. They happen about once a year. So while it's a concern for most people, they don't happen with any great frequency. And then when you start looking at cycles, these types of moves, the big corrective movements, 10% in a short space of time, they happen either early on in the year. We've just seen that happen. We saw those types of corrective moves early in the year. The next time cycle is September, October, something I mentioned several weeks ago now. So I'm not necessarily concerned about a more healthier market correction, again, 10% in 10 days until September, October. Just because historically, cyclically speaking, that's when these things tend to happen. So should we worry about weeks like this week? Should we worry about red days? Should we worry about 2 or 3 red days back to back? Most of the time, no. But if you're not sure, look at where price is in relation to the moving averages, the 200, the 50 and the 20. And we can either say it's noise, it's in rally mode, it's noise, it's below the 50 period, it's in retracement mode, it's noise. If it's moving suddenly below the 200, then yeah, it's probably something to worry about. And as I've just tried to explain, they don't happen that often for it to be panicking. Most of the time, these moves, these corrective days, they're just that. They're noise and nothing to be concerned about. But as we've spent a lot of time on today's session, just look at where price is in relation to the charts, and you'll be able to say, okay, we're in rally mode, ignore it. We're in retracement mode, ignore it, wait for an entry. Maybe if you're in a position, you've got to manage a position. Maybe you raise stops, take profits, whatever the situation dictates. But we've got a way to interpret what price is doing in relation to the moving averages and take the appropriate action. And it's always going to be, don't panic. We know exactly what to do next. So that's where I'm at, folks. Thank you very much for your time. Thank you very much for your attention. Really appreciate you spending an hour with me today. This is the May trade. And once again, we were talking about crashes, corrections, and retracements, how to tell and when to wait. And all we're trying to figure out is where is price in relation to the moving averages. So if you do need a little bit of extra help, we've been going through just one part of the production line trading process. But if you do need some extra help and you want to discuss that with me, I offer mentorship training programs, all-inclusive mentorship programs. Go through the full production line trading process. You should be able to learn it in a very short space of time. For me personally, at the moment, I'm spending about 20 minutes a day or every other day just maintaining my portfolio. It's one of those things you can turn the dial, you can speed things up or slow things down relative to your situation. As I was saying earlier, I want a little bit more of a slower pace at the moment, so I'm slowing things down. We can focus on the best stocks, the best patterns to trade using a proven data-driven strategy to get results. We have a fully inclusive TTE trade management system, which is the real secret to anyone's success. And once you've mastered, you should be able to spend as little as 20 minutes increasing your results over the next 90 days. Build your trade confidence. You'll never be flicking through chart after chart. You don't have to worry about which way the market is going. And you certainly won't be reading boring company reports. So if you want to learn a little bit more about that and to see if what I do is right for you, all you need to do is just go to the main website, AntiVestor.com, and just input your details there and just follow the process. There's a short video after you go there that will just explain a little bit more about what I do. And if you need some help, send me a message. If you don't, if you've got everything that you need from today's session, that's wonderful. Whatever you choose is the right thing, that's fine. Whatever happens, I will see you all at the same time next week.